Hi traders, welcome to the live webinar. Sorry for that delay. I see that apparently the webinar has been already going for a while. It was not clear. Thanks for joining. In any case, this is an FXDD webinar. My name is Chris from Elite Currency, and we're going to discuss how to understand market structure. This is part one of a 3-webinar series. The next part will be for intermediate and then advanced. So we're going to work our way up in the difficulty level here. So looking forward to doing that. Now, before we kick off this webinar, we do want to explain this disclaimer. It's a risk disclaimer stating the fact that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. Good. So let's get started. Market structure. You might be wondering, what does that mean? Well, simply said, it is looking at the chart with a deeper kind of context, a all-around view of what's going on. So rather than maybe focusing on just one element, just one indicator or a combination of indicators, or even just only price action, it's an all-around view of analyzing the market. So you have a deeper way of looking at it, a more advanced way of looking at it, but not necessarily more complicated. The trick is to look at the market structure, the chart, in a more sophisticated way, but not necessarily make it more complicated. It is to do that with more experience, more understanding of the charts, but not necessarily to spend more time. It is actually, you can do that quickly once you get, of course, more experience. How can you look at the charts while using market structure? It depends on these 3 elements. This is the triangle. This is the core of understanding charts. They depend on patterns, the trend, and support and resistance. So when you analyze these 3 components, you understand what's going on. You understand the chart in a deeper way. You can do that in multiple time frame analysis if you like. You can do that on multiple instruments or pairs. But by doing that, you get a deeper view than just looking at only one of these 3 elements. By combining them, your analysis is becoming stronger and more in depth. And I'm going to talk about how you can keep that simple at the same time, because at the beginning, of course, if you look at all 3, you might overcomplicate things. You might get confused. Paralysis of analysis are dangers that are luring around the corner then. But that's a matter of practice. It's a matter of experience that you kind of analyze the chart quickly, but with a deeper kind of context. So that's what the market structure is all about. So let's dive into the charts. I think that's always the best. So I need to close this. There we go. And I'm going to open MT4. There we go. All right. Let's start with the blank chart. Good. So we can dive into all of these things, first of all, just to give you an idea what those are. Most of you will know that, so bear with me, but this is a webinar for beginners. So we do have to cover all our bases. So support and resistance, first of all, what is that? As you probably know, it is a level where price has bounced in the past, where price has reacted to and could react again in the future. Excuse me. And so those are horizontal levels. Those are trend lines. Those could be dynamic levels like moving averages. Those could be semi-automatic levels like, for instance, Fibonacci that we're not semi-automatic, but semi-dynamic, I should say, by the fact that you place it on the chart like this. You can place a fib on the level that you don't see. Yellow is not so good color, but I'm using a different PC now. That's why it is a different color. Let's go to a purple. Unfortunately, my main PC started to reboot out of nowhere just 20 minutes before the webinar. So I'm using my backup PC. So these are semi-dynamic levels because once you place it on the fib, once you place it on the swing, then those levels will stay. But of course, you can move the fib, so it's semi. Horizontal levels will never, move. A round level of 115 is going to be a round level of 115. It doesn't matter. It's going to stay at the same spot. Dynamic levels are moving averages, right? So those are levels where price is the moving average is going to go and change depending on the price movement. Let's add a moving average. There we go. So this is dynamic, as every candle, right? Every new candle will weigh in to that moving average and change the level that is valid. So if price is above it, it could use the moving average as a support. If price is below it, it could use it as a resistance. So there are a lot of different ways of looking at it. You can look at the MT4 and you'll find many indicators, many lines you can add. My personal favorites are trend lines connecting multiple spots or levels like this, for instance. As you can see, would be a trend line. That gives a lot of info. I love trend lines, very useful. I use horizontal levels. So for instance, tops and bottoms are important as well. So if we squeeze like this, you can see that this is a 4-hour chart, euro dollar. We can see that these are levels to think about here. This is a support zone, basically. I like quarter and round levels, 110, 112.50, 115 are useful. Trend channels together with trend lines. I use Fibonacci retracement, Fibonacci target, Fibonacci sequences. I use, in the past, I have used Murray math, not so much anymore. I use moving averages, and I use fractals, my own proprietary indicator, but you can also use the MT4 fractal, okay? Now that's about it. Other good examples are Bollinger Bands or parabolic, Ichimoku. I don't use those though, but they are useful. Alligator, Bill Williams indicators are good support and resistance tools. So those are typical ones as well. GAN, etc. So those are all examples. Now the trick is, of course, to know how you're going to use support and resistance and when. So that's something we're going to discuss together. Let me first finish the explanation of the next triangle of the market structure, which is trend. Support and resistance is very useful to understand when prices are going to stop, right? It showed historical levels from the past, and if it didn't, it could still, just because it didn't stop in the past, it could stop in the future, because a 115 round level, for instance, is typically known to be a bouncing spot. Each of these support and resistance levels could be a bounce or break spot, and is a decision zone. As price arrives to that support resistance, it's going to react or not, right? If it reacts, it's going to reverse or break. So as, for instance, price is approaching here, you see this fall right here. As it approaches 112.50, it made a bounce, right? So if we add a trend line here, for instance, like this, it made a breakout, right? So these trend lines are useful to understand basically key decision zones in the market. Trend is different. Trend indicates the pace, the angle, the direction. Lack of trend indicates that price is going sideways. A trend, of course, is either up or down. A trend is something where price is step by step going into one direction. All right, so let's take a look at a trend here. On this particular piece right here, we have a downtrend like this. And you can see the price has lower lows and lower highs. You can use trend channels. You can use moving averages. I like to use longer term moving averages for the trend, like 21, 34 EMA, 144 EMA. You can use 89.2. These are all Fibonacci sequence levels for the moving averages. You can connect the trend lines, of course, and trend channels to get an idea about the trend. So this was a downtrend. Here there was an uptrend like this. As you can see, we're looking for a sequence of higher highs and higher lows. Now within the trend, you're going to have parts that are faster and parts that are slower. So in this trend here to the downside, you had a fast acceleration to the downside, and then you had price consolidate back upwards, fast to the downside, consolidate upwards, fast to the downside, right? So you have momentum and correction within a trend. That gives a certain angle. The trend channel typically has an angle of about this, right? That's about 30 degrees, 40 degrees. If it's too flat, too shallow, that's not really a trend. It could be some kind of correction. It could be a range. For instance, this part right here, where I have these trend lines, this is quite, this could be a channel. This could be seen as a downtrend channel because we have lower lows and lower highs. But the angle of that channel is shallow, right? So that's already a warning sign that, okay, it's trending down, but be careful. It's not, it's not at a very steep angle. It's not at a trend channel angle. So it could be a correction. So that's true. Price broke above that channel and started to make a higher high. So this was an uptrend, actually, a bigger uptrend channel. So angle is very important. Well, let's take away that one. Angle of these trend channels is important for the trend. You're looking for a sustainable angle. If it's too steep, like this piece right here, then you're looking at a momentum impulse like this piece right here. So that is strong impulsive price action, but the angle is so steep that that channel cannot last forever. That's going to end, relatively soon. There's going to be some kind of correction. So a trend channel is a stable kind of more long-term price action where you have momentum and correction. Now, sometimes you do have momentum that lasts long. Look at this, right? So that's something that's a little bit, you have to take step by step. And sometimes market, responds differently than in some cases than other cases. But this is a good example of a good angled trend channel, uptrend channel, where we have, not too steep. We have some momentum to the upside, correction, momentum, correction. So this is a well-balanced trend channel. Good angle, multiple hits at the bottom. The top in uptrend channel is not as important. You can draw the trend channel like this. So that's an uptrend. And it's good to look and understand all three things: momentum, correction, and the trend channel itself, or the range, right? If there's a range going on, that's good to know too. In this case here, for instance, a triangle going on right here in this piece, but maybe part of a bigger downtrend already, right? So we're looking for a range. Let me see if there's a range here. There's a very good range. This is a ranging territory, absolutely. Right? So this is going sideways. There's no trend here. There's impulse up and down within this range. There's corrections. There's no trend. This is a range. So I'm going very, quickly through all of these concepts because it's about how to address the combination of all these factors. And we could have webinars separately on all these topics, on support or resistance, on trend, if you like. But I'm going to move on in the meantime and look at patterns. That's the third piece. And it's a little bit like the glue between trend and support or resistance. So when you have support or resistance, price might bounce at that level. When you have a strong trend, it's showing a direction. So what happens is that often trend and impulse are in battle with support or resistance. What I mean is that, for instance, here you have, let's say that this is a key level right here. Okay, key support level. And you have a very strong flow, momentum of price falling here, right here. Look at that, very strong, right? Impulsive. This is not even a trend channel. This is just strong momentum. But it approaches a 118.25 level. Let's say that was key because we, for reasons, just let's take that as an example. So price indeed bounced at that level. We have a rally, a retracement. So this is always the constant question is like, what is stronger? Will the trend be stronger, or will price eventually stop at that support or resistance level? So that's something we need to analyze. We need to judge that. And there are some mechanisms we can use to do that. All right, but first let's explain that. Now we had a bounce, but eventually the trend here in this case, which was a downtrend, did eventually win this battle, broke the support, and continued with the downtrend. But later on, right here around 115, the trend wasn't able to go through that level. We got a big bounce, got a retest, second time, third time, no break, right? Until fourth time, not until the fifth time before price actually made a new breakout. So that particular support level managed to hold on for very long. Some support levels managed to hang on and create even bigger reversals. This level right here created a massive reversal, right? So in this case, we had strong momentum to the downside, but we had a reversal from that support zone. So it's a constant battle, if you see what I mean, between momentum, trend, support, or resistance. Understanding market structure means analyzing the chart and understanding what is likely to happen, or even not maybe likely, but you understand what you're waiting for. Will price break? You can wait for candlestick reactions to show what is most likely going to happen. For instance, here, let's say you're not sure what's going to happen, but here's a clear candle break through this. Let's say this candle right here. So you might be taking some shorts to the downside upon a retracement. You know, that's something we'll dive into in later webinars. All right, in part 2 or 3. But in any case, you either have an idea what could happen, and you can trade that, or you can wait for confirmation and trade after the confirmation. But you have an idea where the key levels are. You have an idea what might be more likely. The patterns are like the glue in between that. So you have a lot of info from trend, support, or resistance, but the patterns give you extra information, extra tips about the psychology of the market. Because by looking at patterns, you get to kind of look deeper into the market, and you understand what, from all these pattern clues, what might be more likely to occur. It gives you a little bit more heads up, and it might also prevent you from trading into the wrong direction or waiting for the right direction to emerge. So it's that extra layer of hidden information in a way. And there are a lot of patterns out there, chart patterns. All right. So that's, for instance, bull flags, bear flags, head and shoulders, double bottom, double top, triple top, of course, rising wedge, falling wedge, triangles, contracting triangles, expanding wedges. So those are just a couple of them. And here you see, for instance, a small little flag, maybe not the best example. Let me see if I can find something better. Let's see. Nothing pops into the mind at the moment. Let me dive into the 1 hour chart then. Maybe this right here, triangle, right? Because you have two extremes and you have higher lows and lower highs, right? Here's a little bit of a correction, maybe a flag, right? Not the best flag, but you know, you have to not be that precise with these patterns, I think, right? That's a rough idea what you're looking for, right? Because patterns repeat in the market, but every pattern is unique in a way, right? Every pattern is special. Every pattern will play out a little bit different. So we can use it as a general info, but we got to realize that it's not a guarantee for anything necessarily. We got to always analyze the uniqueness of what's going on right now with the chart. Sure, we can analyze it with these concepts in mind, and we know that they work, but sometimes these patterns don't play out as we expect, and that's something we need to be aware of and be ready for. So let's see if we can find a few more. Maybe this is a neat flag right here. Momentum to the downside, flag like that. Let's see if we can find some reversal pattern. Maybe here we have some kind of triple bottom, maybe, right? So reversal from there. Maybe some head and shoulders pattern here, left shoulder here, head, right shoulder. It's not that precise, but could be something to think about. So patterns are also not only chart patterns, but we have wave patterns, elite wave theory. You have candlestick patterns, of course. You have time patterns, Fibonacci patterns. Let's see. Well, those are the major ones. Oh, yeah, divergence patterns, of course, as well. So those are the 6 major patterns. I'm not going to dive into all of them here. We don't have, it's not the point of this webinar. Just want to tie things all together. So those are major patterns that we can use to understand the market structure better, to understand the psychology of this chart, basically. So once you start to piece all 3 together, trend, support or resistance, or I should say trend, momentum, correction as 1, support or resistance, and patterns, all those 6 main patterns, then you start to create an understanding of the charts that is just deeper than looking at maybe one single indicator, as you can imagine. So let me check if there are any questions. Good, no questions? So let's move on. So let's take a look at an example. 4-hour chart, I think, is a great chart to understand the market structure. A little bit about time frames. I think you can use all these concepts in all time frames. Depends on what time frame you want to trade. So if you're trading the 4-hour chart, nothing wrong with analyzing the 4-hour chart. If you're trading the hourly chart, nothing wrong with analyzing the 4-hour chart. If you're looking for longer term trades, analyzing the daily is fine too, or combining multiple time frames. Nothing wrong with that. But generally speaking, I like multiple time frame analysis. It's good to use daily chart in general for support and resistance. For instance, you can use 4-hour chart for trend, impulse, correction, patterns in general. And of course, 1-hour chart you can use for impulse and for patterns as well. 4-hour chart is the best for trends. And I think you can use support or resistance best maybe on daily and on hourly, not necessarily as a filter, but as a method of trading, if you see what I mean. So the daily chart, you could say, okay, I'm not going to trade the euro dollar right in front of resistance here. But you can use on the hourly chart, you can zoom in and say, okay, I will take this breakout here as a trade setup. All right. So on the daily chart, you're using support or resistance to avoid trading to the upside. But once you see price responding to this resistance zone, like with a good momentum, you see a correction, you put a support trend line like this. So you're using support on a lower time frame to indicate the breakout. All right. And you might take an entry just below this support point that is, for instance, is clearly breaking through the trend line as well. Or you rather wait for the candle close. It's possible too. You'll be entering, of course, a little bit later, but you have more confirmation. All right. You have to survive this pullback, this sideways movement, but then indeed price continues further. So you can use support in this case as a trigger, as a reason for entering, whereas daily would be a reason for not entering. So if I had to choose, that would probably be ideal combination. Daily as a filter, support or resistance. 4-hour is for trend, patterns, impulse, correction. 1 hour is for impulse and correction, and support or resistance as a trigger. But it's really up to you. You can, make any combination you want. You can look at all 3 factors on all 3 time frames, 4 time frames, 5 time frames. Of course, the more you add, more work, more complicated it could be. And of course, it depends on what time frame you're trading. If you're trading lower time frames, wouldn't hurt to check higher time frames. If you're already trading higher time frames, of course, then you don't have to necessarily check much more. But in some cases, if let's say you're trading the daily and weekly, you still might use the 50-minute chart, but just purely to find an entry, for instance. It's possible too. So there are a lot of options, combinations possible. I'm just giving you some ideas to think about. If you rather focus on one time frame, that's fine too. But if you want to make sure and be careful that it's not maybe a 50-minute chart. I'm not a big fan of trading only the 50. I think you don't have the context personally. So, but on a 4-hour chart, only the 4-hour chart could be okay. All right, but I'm not doing that. I do use multiple time frame analysis. So let's use an example. Let's look at the euro dollar right now. So what do we got here? Let's take a look at the daily chart. And we can see the price is right at this support zone at 112.50. And price responded to the upside. There was some reaction to that. But we can also say, look, we got clear lower highs. So this is looking from this perspective as a pattern. It is a descending wedge, which is actually bearish. So that is something to note. Let's take a look at the 4-hour chart. We have strong momentum to the downside. And we have momentum here too. We have lower lows, lower highs. So downtrend in place, plus we have bearish momentum. Now price did break above that bearish momentum, but we know that sometimes these corrections are just corrections. So for the moment, as long as price stays below this resistance trend line, we're still more in a bearish kind of trend on this 4-hour chart. Okay. But if it would break above this resistance spot, of course, that would change things. Now, looking at patterns on this 4-hour chart, if you like Elliott wave theory, excuse me, then you might see, excuse me, an ABC correction, this being wave A, B, C. So that would favor upside and reversal, in fact. Right? So despite the downtrend, this pattern is a warning for you. That's something about, something might be going on here. If we look at the 1-hour chart, we see momentum to the upside as well. But now we see momentum to the downside. So a little bit tricky. And momentum to the upside will certainly be something to be careful of at that point, right? Could indicate maybe the start of a new upside. So it is overall, this particular spot is unclear. It is bearish on the daily and 4-hour, but it is at strong support zone, and there is some mixed momentum. So at this particular spot right here, it is a little bit tricky. If for instance we were looking at the charts maybe here, maybe downside would have been a little bit better at that particular point, because there was some more space to that spot, right? This is just analyzing it from a discretionary point of view, right? Because the support zone is so close by here, 20 pips, 30 pips from here. If you had it a little bit higher, you would have a little bit more space. For instance, this bearish engulfing twin, for instance, here, that could have been a better spot to think about some trades. Now price has already fallen to the downside from that spot. Excuse me. So let's take a look at a spot where maybe things were a little bit more clear. Find some example. And of course, this is in retrospect. So, but yes, we do add wave analysis. I add my analysis in general regularly, so you can verify what I was thinking. That is just not, this is going to be a little bit idealized, of course, because it's a retrospect example. But let me see if I can remember something that I was actually analyzing. Let me think. Let me zoom out here to the 4-hour chart. Yes, I think that I was looking at, this is all pretty messy on the euro dollar, to be honest. Not, there's not much good examples because price has been pretty choppy, to be honest. Maybe I could look at the pound dollar. Hang on. All right. So if my memory serves me correctly, all right, let's take a look at this chart at this point. All right. So daily chart. Where's the support or resistance? So we do have a resistance line here. We have horizontal levels up in here. There we go. 4-hour chart. We see a potential uptrend channel. We see a bounce at the uptrend channel here. Oh. Right here. So this is a third hit. We see momentum to the upside. And we don't see any particular patterns at this point, I would say, but not here. We did have a pattern maybe here. But let's see, not at this moment. Let's take a look at the hourly chart. Oh. There we go. All right. So we have, one more thing. We have a bullish candlestick pattern here, just before this red line, indicating the bounce, indicating that's one pattern. We have a potential wave 4. And if we put a fib from here to here, all right, we see a 38.2 fib bounce, another pattern, or in this case, support or resistance, actually, sorry. Let's see, we have 1-hour chart. We have price breaking through the counter trend, resistance trend line like this. So let's add it up. We have some space to resistance, enough for a trade on the hourly chart. We have uptrend. We have a wave 4, bounce off the 38. We have a break of the counter trend line on this hourly chart. So those could be a particular spot that's interesting from a market structure point of view. Let's take a look at one more example. Let's take a look at Australian dollar, maybe. Alrighty. Good. So let's take a look at here, for instance. So we see strong momentum to the upside, and we see that price was making a correction. So overall, the trend is down on this daily chart. All right, we can clearly see that. But from a pattern point of view, we know that there's impulse to the upside, and that this could be a bigger correction, for instance, an ABC correction. So after the correction finishes, there could be another push up, for instance. So although the trend is down, we would expect a dip and one more test of the higher high based on this wave pattern, based on this momentum as well, by the way, not only the waves, but the momentum. And then we would expect the downtrend to continue once it hits the resistance. So let's take a look at this 4-hour chart. Same thing, momentum. Price is making a corrective pattern here, as you can see. It is choppy and a shallow angle. So In that case, we know that it could just be a correction within the trend. And on the hourly chart, all right, there we go. We can see that maybe let me add to the indicator. Sorry for that. I'm still recovering from a cold, so excuse me for my throat. There we go. Let's add the awesome oscillator. There we go. So let's see. There's no divergence in this case, so it didn't really help, actually. But sorry. But we have this resistance trend line. So let's go back to the 4-hour chart, I think. All right. There we go. So break of this flag right here, for instance, could be one way of trading it. You see a correction after that. So you can even, for instance, wait for this flag break, wait for a correction and trade either the retracement or the bounce or the breakout itself. That is something we're going to discuss a little bit more in detail, how to trade it, the decision zones, the bounce and break spots, bounce break pullback concept, continuations concept. We're going to talk about decision zones, triggers, and entries, how to trade this analysis basically in general. This first part was just to explain the general concepts of analysis. So as you can see, it doesn't have to be too complicated. Of course, you have to know what to cherry pick, what to analyze, what you think what is important or not. This might take some time, and you want to practice this. Of course, you want to demo trade it, see how it works for you, etc. But analyzing it is all about understanding momentum correction, understanding the trend, understanding support and resistance, and support and resistance and trend and patterns, of course. Now, one thing I want to add next time is talking about when price is likely to break or bounce. We'll talk about that as well with regard to decision zones. That's very important so that you understand what you're looking for, right? For instance, although you might be a with a trend trader, after price makes this upside, you might be looking for a reversal, because although price is in uptrend, one could say, with higher highs, you know that you're actually looking at a downtrend on the daily chart. So, and it's running into resistance. So at all points, you know, you could be looking for reversal or retracement trades or continuation trades, trend continuation trades. Depends on the spot, depends on all these factors, how you weigh them in. All right. So you might be looking for continuation trades here, but once price makes a higher high and shows some downside, you realize that the ABC is completed, perhaps price is running into resistance on the higher time frame, and that you're actually now at this particular spot, you might close your long for profit, and you might be looking for short setups. Okay, so let me see if there are any questions. Nothing so far. Okay, great. So this is how you combine support or resistance, once again, patterns, trend, impulse, to make a deep analysis, but not necessarily something that takes you a lot of time. Each point will either have, there will be points where you don't like to trade, where you rather wait for more information. There'll be points where you're interested in trading if price reaches this level, if it breaks, if it bounces, only in that direction or that direction. All of that depends on this analysis. As I said, with this example I showed you, right? The break of the flag, good trade for upside perhaps, but not before the flag maybe breaks. Maybe that's too risky, right? Depends. Maybe in other cases you will trade before the flag breaks. When you have a higher high and you see price reversing, well, then that could be a reason to close the previous trade and think about the other direction. I'm not saying that you always have to trade every single spot or every single direction, but based on this analysis, you can make that judgment if you're interested or not, and when you're interested. All right. So that's it for now. Hope that it helped. This is the basics of analyzing the chart. Of course, it will take some practice. Once again, don't get discouraged at the very beginning. You need some time to practice and get feeling for it. And you know, I understand that showing it like this might make it seem very simple. That does take some time to really master. So don't get frustrated by that. It's normal learning process. And next time, join us for our intermediate part 2 webinar. And we're going to take a look at how to measure bounce breaks and decision zones, etc. So that's coming up, let's see, on next week, Sunday. That's the 24th of February. That's going to be the second part. There we go. Let me see if I can find that. There we go. More webinars coming up soon. As I said, the part 2, but also live trading webinars. These are the links. Top one is for live trading. Bottom one is for education. Wish you all great trading and talk to you soon, folks. Cheers.